Hello everyone, my name is Rick Happle, Portfolio Manager at Jaffe Tilschen Wealth Management. Thank you for watching my February Investment Musings video. What concerns me today is market breadth. That's the difference between advancing and declining stocks. With the recent advancement in the S&P that's at all-time highs, close to 5,000 actually, what we've witnessed is more declining stocks than advancers, and this spread keeps widening. This is what we refer to as a non-confirmation. If the market's going up, you want to see the number of advancing stocks increasing as well. My base case is because of extreme valuations that the market broadens out to other sectors. We're beginning to see this occurring. It's going to be hard to double Apple from here, but other technology companies just might. Imagine a pyramid. At the bottom of the pyramid, at the base, is NVIDIA. They were the first company that really kicked off the whole AI enthusiasm. Above that was Microsoft in software. The next logical step that I see occurring is computer services, because you have to hire a company like IBM, which we own, or Accenture, to come into your company and give you advice on how to use this new AI application. Then, to run all of this AI, we need a significant increase in data centers. That's the cloud. It's really down on the ground, off the interstate in a big warehouse. As far as eventually at the top of the pyramid, we're all going to wind up replacing PCs as well. So, as far as looking at technology, it's just not all about the Magnificent Seven. It's the entire technology index, and that's how we're positioned. So I'm positive on the S&P 500 this year, but we need to talk about the big thing. Never lose focus of the big thing, and always remember to consider the big thing in your allocation. So just what is the big thing? It's risk management. What I'm focused on here is being properly diversified, and I understand investors have gone through a period of disappointment with the 60-40 stock bond allocation for managing risk, because in 2022 both stocks and bonds went down together. At this point, a lot of investors now have 80% stock instead of 60. This runs the risk of you not being a happy retiree if you're in the pre-retirement phase of your life. But what really has me concerned today is the market analog that we're experiencing right now looks very similar to three historical periods. One is 1999. In 1999, we had a technology bubble. Imagine at the end of the year, you decided to retire. The excitement of the internet caused your stock portfolio to expand in value, giving you enough confidence to quit your job. Then the market saw 2 consecutive years of steady declines immediately following your retirement, and for the entire decade of 2000 to 2010, the S&P 500 averaged a negative 1% annual return. However, if you retired on January 1st of 2009 following the financial crisis, you would have been fine. There are 2 other periods in history that follow this analog. 1929, we had 826 stocks in the stock market. RCA was probably the most popular at the time, and in 1929, only 19 stocks were driving the market higher. Then, in the 1970s, we again witnessed narrow leadership with the Nifty 50. Those 3 examples, 1929, 1970, and 1999, all had subsequent decades of virtually no return. In summary, presidential years typically averaged 10%, and most of the time they're back-end loaded with a weak first quarter. Diversification last year resulted in underperformance. Not only did, of the 11 sectors, not only did the 10 sectors not perform well, most of them actually declined. Managing risk has never been more important. Imagine this, you're a pre-retiree, your home is paid for, so there's no bank requiring that you carry homeowners insurance, but you still do, right? Your investment portfolio potentially could be larger than your home's value. So how could you have a buy and hold strategy with no risk, proper risk management on your investments? As far as proper risk management, well, one of the things that I attempt to do is I try and recognize any losses quickly, and the stocks that turn out to be winners I hold for a long time. In addition to that, my diversification approach includes gold, oil, diversified commodities, managed futures, private equity, private debt, and some hedging strategies to replace that bond portfolio that existed in the past. I believe that adding dissimilar asset classes will help stabilize the value of your portfolio, and drawing a monthly or quarterly income in retirement, that's the key to success, is avoiding big declines if you want to have a secure income. Please reach out if you'd like a second opinion on your investing strategy and portfolio, and thank you for your time today.